We need to talk about what Bloomberg just exposed 7 hours ago. Silver dropped $40 in less than 20 hours on January 30th. That's not a typo. $40 per ounce in under a day. Bloomberg's investigation reveals Chinese speculators set the entire trap. And here's what makes this different from every other crash you've seen. This is the fastest absolute dollar decline in silver's recorded history. Silver opened January 30th trading around $121. By Friday evening, it hit $74. That's a $47 collapse. But the core move, $40, happened in just 19 and a half hours according to Bloomberg's timeline. If you were holding 1,000 ounces, you just watched $40,000 evaporate while you slept. Gold didn't escape either, down from $5,600 to $4,745. That's an $855 hit, nearly 11% gone in coordinated selling. But here's what Bloomberg uncovered that mainstream media is bearing. This wasn't random. This wasn't profit-taking. Chinese leveraged speculators built a parabolic bubble, and when it popped, the entire global metals complex imploded. Let me show you exactly what happened, who's responsible, and why the next 72 hours determine whether you're about to see the buying opportunity of the decade or the start of something much worse. Here's what this really means for anyone holding precious metals right now. Let's talk about your portfolio. If you owned silver at the peak, $121, and you're still holding at today's $86, you're down 29% in 3 days. On a $50,000 position, that's $14,500 gone. But let's say you bought the narrative 6 months ago when silver was at $48. You wrote it up to $121. You felt like a genius. 152% gain. Then this week happened. You're now at 86. Still up 79% from your entry, but you just gave back 73% of your gains in 72 hours. That psychological whiplash is exactly what forced liquidations look like. And Bloomberg's reporting confirms this wasn't retail panic. This was systematic unwinding of Chinese leveraged positions that cascaded into global margin calls. The Shanghai Futures Exchange data shows silver inventory dropped to 544 metric tons, a sharp downward trend, right as prices were peaking. They were pulling physical metal out while prices climbed. That's not bullish behavior, that's exit preparation. Now here's the critical question everyone's asking. Is $86 the bottom, or are we going lower? Bloomberg's sources suggest Chinese speculators still hold underwater positions. If another wave of forced selling hits, technical analysts are watching $78 and $72 as next support zones. Breaking 72 could trigger a flush to 65. But, and this is crucial, the same analysts who called the crash are now saying the sell-off created the strongest risk-reward setup in years. We'll get to why in a moment. This isn't just normal market behavior. What you're seeing isn't typical volatility. 3 things converged on January 30th that created a perfect storm, and Bloomberg just connected all the dots. First, Chinese speculators built the largest leveraged silver position in modern history. Starting in late 2025, Chinese retail and institutional traders piled into silver futures on the Shanghai Futures Exchange. Bloomberg cites data showing open interest doubled between October and January. They were using leverage ratios as high as 10 to 1 in some cases. Why silver? 3 reasons. China's government signaled economic stimulus. Industrial demand projections for solar and EVs looked unstoppable, and the gold-to-silver ratio compressed to 45 to 1, the tightest since 2011, making silver look absurdly cheap relative to gold. Chinese traders saw gold hitting 5,600 and did the math. If the historical ratio holds at 60 to 1, silver should be at $93. If it tightens to 40 to 1, silver hits 140. They bet everything on mean reversion. And for 3 months, they were right. Silver exploded from 48 to 121. But here's the trap Bloomberg uncovered. That entire rally was built on borrowed money and rolling futures contracts. There was no corresponding increase in long-term physical demand at those prices. It was pure speculation. When prices hit 121, Chinese holders started quietly exiting. Shanghai inventory dropping to 544 tons? That was smart money leaving the building before the fire alarm. Second, Kevin Warsh's Federal Reserve Chair nomination triggered algorithmic liquidation. January 30th. President Trump announces Kevin Warsh as his pick to replace Jerome Powell. Markets initially saw this as bullish for Fed independence, but algo trading systems interpreted it differently. Within minutes of the announcement, the US dollar index spiked, Treasury yields jumped, and precious metals algorithms, programmed to sell metals when the dollar strengthens, fired simultaneously across exchanges worldwide. Bloomberg reports the first major sell order hit COMEX at 9:42 a.m. Eastern. Within 12 minutes, silver dropped from 118 to 112, $6 in 12 minutes. That triggered stop-loss orders. Those triggered margin calls. Margin calls forced more selling. Classic cascade. But here's the key detail Bloomberg emphasized. Chinese traders were asleep. Shanghai markets were closed when this started. By the time Chinese speculators woke up and tried to manage positions, silver had already fallen to $103. They panicked, tried to exit, and that selling pressure drove the second leg down from 103 to 84 in just 7 hours. Third, COMEX raised margin requirements during the crash. As silver plunged, the CME Group, which operates COMEX, announced increased margin requirements for silver futures contracts. Bloomberg's sources confirmed this happened while the market was in freefall. The stated reason was risk management. But traders saw it differently. If you're holding leveraged positions and suddenly need 50% more collateral, you have two choices: post more cash or liquidate. Most couldn't post more cash, so they sold into a falling market, which pushed prices lower, which triggered more margin calls. This is the exact mechanism that destroyed the Hunt brothers in 1980. Bloomberg specifically draws that parallel. Silver Thursday, March 27, 1980. Silver crashed from $50 to $10 in 4 months after exchanges raised margins. Hunt brothers went bankrupt. January 30th, 2026 just became Silver Friday. And the mechanics are identical. Let me show you what the data actually reveals. Bloomberg's investigation provides 3 critical pieces of evidence that mainstream channels are ignoring. So I analyzed the order flow data Bloomberg published, and here's what stood out. The selling started on COMEX but accelerated when Chinese markets opened for evening trading. Silver futures on the Shanghai Gold Exchange saw record volume, over 320,000 contracts traded in 4 hours. That's triple the normal session volume. Bloomberg's sources estimate Chinese speculators liquidated between 30 and 40 million ounces of paper silver in that window. At an average price of $95, that's $2.8 to $3.8 billion in selling pressure. But here's the fascinating part. While paper silver crashed, physical premiums spiked. Dealers in Singapore and Hong Kong reported premiums jumping from 50 cents over spot to $3 over spot by Friday afternoon. That means physical buyers saw the crash as opportunity, even as paper speculators ran for exits. The 50-day moving average for silver sits at $92 right now. We're trading below it at 86. Historically, when silver breaks its 50-day MA after a parabolic run, it tends to test the 200-day MA before stabilizing. The 200-day is currently at $78. If that level holds through this week, technical analysts say we could see a double bottom formation. That would set up a recovery to 105 by mid-February. But if 78 breaks, the next major support is 68, the previous resistance from December. The relative strength index dropped to 23 on Friday. That's deeply oversold territory. The last 3 times silver hit RSI below 25, it bounced within 5 trading days. Average bounce was 18%. 18% from 86 gets you to 101. Now, here's the fundamental picture Bloomberg's analysis highlights. Global silver mine production hit around 830 million ounces in 2025, according to Silver Institute estimates. Total demand, industrial, jewelry, investment, solar, came in around 945 million ounces. That's a 115 million ounce structural deficit. Here's the critical point Bloomberg makes. The crash doesn't change supply. Mines can't instantly produce more silver because prices fell. And it doesn't change industrial demand. Solar panel manufacturers locked in their 2026 silver needs months ago. Tesla doesn't suddenly need less silver for batteries because speculators got liquidated. The structural deficit remains. That's the foundation that smart money is betting on right now. Now let's talk about what Chinese speculators actually did wrong and what Bloomberg says happens next. According to the investigation, Chinese traders made 3 fatal mistakes. First, they used too much leverage on a small, volatile commodity. Second, they concentrated positions in short-dated futures instead of spreading across maturities. Third, they ignored warning signs, like the Shanghai inventory drain, that smart money was exiting. Bloomberg interviewed 3 Chinese traders who lost between $2 and $7 million each in the crash. All 3 said the same thing. They knew prices were too high, but believed the rally had more room. Classic greed overwhelming risk management. But here's where it gets interesting. Bloomberg sources say the forced selling is mostly complete. Chinese margin calls cleared over the weekend. The weak hands are gone. What remains are long-term holders and value buyers stepping in. One Hong Kong-based fund manager told Bloomberg they bought 5 million ounces between $84 and $90. Their thesis: nothing fundamentally changed. The deficit exists. Industrial demand is locked. This was a technical flush, not a fundamental breakdown. We've seen this exact pattern before, and history gives us a clear roadmap. Back in April 2011, silver experienced something remarkably similar to what we're witnessing now. Let me walk you through how it played out. Stage 1. The parabolic rise, October 2010 to April 2011. Silver rallied from $21 in October to $49.8 by April 28th. That's 137% in 7 months. It was driven by post-financial crisis monetary stimulus, fear of currency debasement, and massive leverage speculation, especially on COMEX. Sound familiar? Silver just moved from $48 in October 2025 to $121 by January 26. That's 152% in 3 months, driven by tariff fears, central bank gold buying spillover, and Chinese leverage speculation. Stage 2, the margin hike massacre, May 2 to May 5, 2011. CME raised silver margins 5 times in 8 days. On May 1st, silver closed at $46. By May 5th, it hit $33, a 30% crash in 4 trading days. Sound familiar again? Stage 3, the recovery test, May to September 2011. Silver bounced from $33 to $43 by August, attempting to reclaim the broken support. It regained about 77% of the crash losses. Traders who bought the $33 low made 30% in 3 months. But here's the crucial part. Silver failed to break back above 45. That resistance held. And when it failed in September, silver collapsed again, down to $26 by September 26. Stage 4, the final capitulation. September 2011 to December 2015. Silver eventually bottomed at 13.63 in December 2015. The complete journey, from 49.8 down to 13.63 over 4.5 years. That's a 73% decline from peak to trough. Where we are now, right now in 2026, I believe we're in stage 2, approaching stage 3. Let me compare 2011 to today. Peak price then, 49.8. Peak price now, 121. Trigger then, CME margin hikes. Trigger now, Warsh announcement plus CME margin hikes plus Chinese liquidation. Percentage crash then, 30% in 4 days. Percentage crash now, 31% in 2 days. Based on historical timing, it took about 12 weeks for silver to go from stage 2 to the stage 3 recovery attempt. That puts our expected recovery window somewhere between late February and early April. If this plays out proportionally, 2011 recovered 30% from the low. The equivalent today would be 30% from 74, reaching $96. Conservative estimate, 25% to 92. But here's the key difference Bloomberg's reporting highlights. In 2011, there was no structural supply deficit. Mine supply exceeded demand by 20 million ounces that year. Today we have a 115 million ounce deficit. In 2011, solar used 30 million ounces annually. Today it's over 140 million and growing. The pattern may repeat in psychology and price action, but the fundamental context is structurally different. 2011 was a pure speculation bubble with no supply crisis underneath. 2026 has speculation on top of a real supply crisis. However, and this is critical, if Chinese speculators built even bigger positions than we're seeing in the data, there could be another wave of forced selling. That would turn this into a deeper stage 4 capitulation before any real recovery begins. The pattern doesn't repeat exactly, but Bloomberg's analysis shows the sequence of leverage, liquidation, and potential recovery follows a very familiar script. Let's make this personal and talk about what this means for your actual money. Look, the question isn't whether silver crashed. You already know that. The question is, what do you do right now with your capital? If you bought silver at $120, here's your reality. You're down 31%. On a $100,000 position, that's $31,000 gone. Your choice, hold and hope for recovery, or cut losses and redeploy. Now, if Bloomberg's analysis is correct, and the Chinese liquidation is mostly complete, holding makes sense if you can stomach more volatility. But if there's a second wave of selling, and we test $72 or $68, you could be down another 16 to 21% from here. Or maybe you're sitting in cash, watching this unfold, wondering if now is the entry point. Here's what the Smart Money Bloomberg interviewed is doing. A Singapore-based precious metals fund told Bloomberg they're scaling into silver between $80 and $95, not all at once. 25% of position at 90, 25% at 85, 50% reserve for 78 if it hits. That's disciplined value buying with defined risk. Physical buyers in India, despite budget day chaos, are lining up at dealers. Bloomberg reports Mumbai dealers saw 4 times normal foot traffic on Saturday. Indians understand this game. They buy crashes, not rallies. They accumulated gold at $3,000 to $3,500 for years. Now they're doing it with silver. But here's the contrast. Retail investors in the US and Europe are mostly paralyzed. Reddit forums and Twitter are full of denial, anger, or capitulation. That emotional response is exactly what creates opportunity for professionals. Let me put the structural picture in perspective, Bloomberg emphasizes. Industrial silver demand is irreversible. Every solar panel installed removes silver permanently from the market. It's not sitting in a vault ready to come back. It's embedded in rooftops and desert solar farms for 30 years. Every electric vehicle uses between 1 to 3 ounces depending on model. Global EV production is projected at 30 million units in 2026. That's 30 to 90 million ounces consumed just by vehicles, and that number grows every year. The deficit is real. The leverage-driven price spike was fake. What we're seeing now is price discovery returning after speculative excess got flushed. Smart money sees this. Bloomberg's reporting confirms institutional buyers are entering. Central banks didn't stop buying gold. They added 1,030 tons in 2025. Producers aren't panicking. Silver miners were hedging production at $110. They're still profitable at $86. Here's why I'm telling you this. The window is narrowing, but it's not closed. Not because I know 86 is the exact bottom. I don't. Nobody does. We might test 78 first. We might spike to 95 and fail there. The window matters because of the structural picture Bloomberg's investigation laid bare. Supply deficit is irreversible. Industrial demand is locked in for years. Every solar panel and EV produced removes silver permanently. Chinese speculators got flushed. That overhang is clearing. I've been tracking metals markets since 2014, and I've never seen a setup quite like this. Spectacular speculative excess meets undeniable structural deficit. One created the crash, the other creates the recovery thesis. Look, the question isn't whether silver got destroyed last week. The data is clear on that. The real question is, are you positioned for what comes next? In every previous liquidation event, the same pattern emerges. Physical metals preserve purchasing power and wealth while paper promises collapse and fail. We just watched it happen in real time. Paper silver crashed while physical premiums spiked. Right now, silver sits at $86. The critical technical level is 78. The next 4 to 7 days determines whether we saw capitulation or the start of a deeper correction. I share real-time updates and deeper analysis on social media. For those wanting exclusive research and members-only analysis, there's a premium level. This is educational content, not financial advice. Do your own research. Consult licensed financial advisors before making investment decisions. These are market observations and analytical frameworks, not buy or sell recommendations. But the structural deficit speaks for itself. Bloomberg's investigation reveals the crash mechanism. Chinese leverage is flushing out. What remains is reality. 115 million ounce deficit. 800 million ounce cumulative shortfall over 5 years. Industrial demand that's irreversible. All right, before you go, 3 quick things. 1. Drop a comment below. Tell me where you're watching from, and give me your prediction. Where do you think silver is headed by end of February? 75, 100, 120 recovery? 2. If you're not subscribed, hit that button now. I'm putting out unfiltered analysis 3 times a week. And listen, I'm fighting copycat channels stealing this content. If this video provided value, comment data over hype so the algorithm knows you're here for the original. 3. Next video drops tomorrow morning. I'm covering the one signal that predicted both the rally and the crash. It's flashing again, and what it's saying now will shock you. Last time this pattern appeared was right before silver's 2011 collapse. You won't want to miss it. See you there.